Retirement plans for self-employed workers and freelancers. This is Ken Boyd. So let's talk about how retirement plans work. The most common form of plan is a 401k. The structure may be a little bit different if you're a freelancer, but the concepts are the same as if you're working for a company. So think about it this way. Most 401k plans allow you to invest pre-tax dollars that have not been taxed, into a retirement plan. Let's say that you want to invest $100. If you use the company's 401k plan, the entire $100 is invested, which means you earn earnings on all 100, and they aren't taxed until you take money out of the plan at retirement. If you invested outside of the plan, taxes would be taken out. My example here, well, what if you only put in $80 because it's after tax dollars? We're over 20 or 30 years, that extra $20 investment that you can put into the 401k before tax can make a huge difference in your return when you do it year after year. That's the key at the top. The extra dollars you can invest because the dollars are not taxed until you take money out. So how do you open a 401k without an employer? There's several ways to do it. I have some quotes here from Investopedia. First, a sole 401k. You as the self-employed person act as both the employer and the employee, which means you're putting in both the employer share and the employee share into the 401k. Another option is a SEP or SEP, which allows individuals to contribute pre-tax earnings. Now, it's important to know that only the employee can contribute to a SEP, not the employer. And there are some other requirements, like being 21 years old, work for a company 3 of the last 5 years, and you make at least $600 a year. The big reason why these retirement plans are such an advantage is compound interest, which I call the magic of compounding. And compounding interest refers to earning interest on top of interest. When you compound interest, your total earnings can be much higher. So let's say that you invest $1,000 at a 5% rate, with total annual interest earned of $50, 1,000 times 5%. So that's how much you make in year one. But in year two, you are investing the $1,000 plus the year one earnings of 50. So that's $1,050 in year two times 5%. You earn $5,250. So the point being, by investing an extra $50, you earn $5,250, or $2.50 more than in year one. That is the magic. And over decades, it can make a huge difference. If your retirement plans for self-employed also have an impact at the state level, you see this quote from the Pension Rights Center that millions of employees are self-employed as of 2018, and that number has only grown up recently. So much like health insurance coverage, there are a number of states that offer state-specific retirement plan options for self-employed. So check with your state. As of 2018, 10 states have created retirement plans, and more states have created them since then. So check with your state, because it may be more attractive to invest in a state plan. And for more information on accounting and finance, you can go to conferenceroom.com.